everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Lyn Alden of Lyn Alden Investment Strategies. How you doing today, Lyn?
Pretty good. How are you?
I'm doing okay. Just, feel like I'm having a better day. It's been a rough couple of weeks, but I'm excited to be here with you, one of my favorite analysts in the space. And so this is a good day. So let's go ahead and start with the CPI inflation that came in hotter this morning. Was up 0.9% month over month, and I think 3.3% year over year. And so I'm curious if investors should be worried about a more hawkish Fed response and if this inflation stays elevated.
Yeah, good question. I mean, the CPI print obviously came in hot. It didn't come in as hot as it could have. It didn't exceed expectations because the expectations were already pretty high given everything that's happened. Especially obviously from energy and then associated downstream costs of that, like transportation. So we kind of see inflation working its way through the system. I do think that all else being equal, this makes it harder for the Fed to cut interest rates. We have likely a new chair coming in, this summer. That's not really there until it's confirmed, but that's kind of the president's proposal. I think before this crisis, he likely would have been more dovish. But I think this kind of forces him to pause a little bit. It's hard to cut when you really have interest rates rising. Now, back in 2022, when asked about energy prices, when we had when Russia invaded Ukraine and oil spiked largely because of that, Powell said that they would kind of look through energy inflation per se, they're more focused on broader inflation, and I think probably they'll take a similar approach. So I don't think they're going to start hiking and trying to tamp things down, because the Fed's tools are really around a couple main things. One is they try to slow down or accelerate bank lending. And two, they try to kind of harden or weaken the currency relative to other currencies with all those interest rate differentials that they do. And when you have something like a acute shortage of something like energy, their tools don't really address it, because they can try to bank lending's not at an excessive pace right now. That's not the source of inflation. Fiscal deficits are contributing to inflation, which the Fed can't do anything about. And raising interest rates is going to have no effect on the deficits. If anything, it blows out the interest expense a little bit. So none of the things that are causing inflation are really things that the Fed can do much about. They can be hawkish enough to put other parts of the economy in a recession, but then who benefits from that, really? So they don't really have a lot of tools here. So I think they're probably, whether it's Powell or whether it's the new chair coming in, I think they're going to kind of be in a holding pattern until some of this chaos subsides.
Yeah. And you recently wrote a piece on understanding fractional reserve lending and banking, and you talk about broad money and base money. And I'm curious in just how that relates to inflation. So obviously in this inflation we're seeing with energy prices spike, and then let's say fertilizers spike and food prices go higher and such. That's a different form of inflation than the Fed increasing base money or banks increasing broad money through fractional reserve lending. And so curious in the difference there.
Right. So there's a couple layers we can go on. One is, there's base money, which is determined by the central bank, and then there's broad money, which is primarily determined by commercial banks. And so when we have money in our checking or savings account, or that's the much larger figure, and that's broad money. And when they just increase base money only, it tends not to be very inflationary, because it's not actually getting out to those that spend. For example, in 2008, 2009, when they did the initial QE in response to the global financial crisis, that was a big jump in base money, but it was primarily just to recapitalize banks. It didn't give a spike in broad money. Whereas what made the COVID stimulus different was that it was a spike in broad money, because they literally were sending checks to people and businesses and then monetizing a lot of that. So that's the whole kind of a money system itself. And then separate from that, when you have a supply shortage in something, especially something critical like energy, you do get price inflation in key things. The issue is that as long as you're not like stimulating, like unless you're not like you're not giving people say like gasoline credits or something, then that tends to be inflationary in those areas. But it's not accelerating the broad money supply growth in any meaningful way. And so the average consumer doesn't have any more money. And so if they're paying more in gasoline prices, and over time, if they're paying more in transportation and goods prices, because the input for many goods and transporting those goods around is energy and raw materials, if they're paying more for that kind of essential stuff, and they're already on a tight budget, they're likely then trimming spending elsewhere. They're trimming on discretionary spending, or sometimes other key areas. So there's actually a disinflationary effect often elsewhere, at least maybe not in a few months, but over the longer term, unless again you stimulate into that shortage. So this is a at the moment it's a temporary price increase from issues rather than a change in the pattern of money supply growth. If this, absent this whole Strait of Hormuz supply shock, we have a situation where the monetary base is gradually increasing again. So the Fed has ended quantitative tightening, and they're now in a gradual period of kind of persistent monetary base increase. And then on top of that, we have banks lending, fraction reserving that monetary base. And so that's growing as well by somewhere around 7% per year. So we have this kind of structural underlying debasement going on, and how prices respond to that is largely a function of productivity. If you have a ton of growth in supply of goods and services, let's say AI just makes all sorts of things more abundant, then you can have a pretty substantial amount of money supply growth and not necessarily see many prices go up, because there's not really shortages of things, and that most of those price increases would therefore consolidate around the truly scarce things, gold, waterfront property, fine art, maybe Bitcoin, the highest quality stocks, financial assets, the highest quality type, rather than goods and services for the most part, unless there's certain pockets that are shortage. But when you have war, when you have energy shortages, all of that is basically negative productivity. You're taking away the abundance of goods and services, or at least some of the inputs to those goods and services. So you have money supply growth without the growth of goods and services, which is how you get, on average, higher prices.
Okay, got it. Yeah, that's a clear breakdown of the difference of what we're seeing there. Curious in your perspective. So you've always you've talked about fiscal dominance for quite a long time, and then also you mentioned that nothing stops this train in fiscal dominance. And so I'm curious in how does this conflict with Iran reinforce or challenge that thesis?
Well, it reinforces it. And it's either neutral to it at bare minimum, or it accelerates it. And so I've been in the camp. So there's the, they call it the big print camp, where people say, a thing's just around the corner, we're going to print a ton of money, like COVID. People have been saying that since a year or two ago, and it's not really happened. And I've been in the camp that no, we're in a gradual print scenario as a base case, meaning that, and this is before the Fed started ending their balance sheet reduction and resumed growth. My view was that was going to happen, that they were going to end it. They were going to go back to roughly increasing their balance sheet in line with nominal GDP. To kind of maintain kind of a persistent percentage of nominal GDP, roughly speaking, or like a persistent percentage of, say, total bank deposits, kind of a proxy for broad money supply. And that's roughly what they're doing. They're in a gradual print scenario, which, we're running $2 trillion deficits. Those are going to keep, maintaining and growing as far as the eye can see. Nothing stops that train. The central bank will monetize a portion of them where necessary to keep liquidity in the banking system, keep liquidity in the treasury market, and all this. And all of that is this kind of this persistent background debasement inflation. And when, outside of the Iran war, we'd be in a gradual print scenario. Now, the Iran war comes in, and the only challenge that it potentially does is it does increase the odds of a bigger stimulus or a bigger print scenario because whenever you have crisis, it increases the odds that something breaks and therefore there's a response. So, for example, if the strait is closed for a long period of time and you have acute energy shortages in creditor nations that hold a lot of treasuries, and they sell treasuries to buy $200 oil, for example, you could have the Fed potentially have to increase its monthly treasury purchases to accommodate the selling from energy-starved creditor nations. That's still not my base case yet, but every month that it goes by, kind of like if you ask me what is the probability of that happening 2026 in January, I'd assign a certain number. And if you ask me, here in March or April, now that there's a war going on, now that there's an acute energy shortage globally, I don't have a precise number, but that number is higher than it would have been in January. So a gradual print is still my base case, but we have increased the right tail risk of some of these bigger print scenarios because we've increased the risk of financial disruptions due to creditor nations being energy starved.
Okay, yeah, that makes a lot of sense. So there's been concern about, obviously, you mentioned that the odds of a bigger print coming has increased, and some folks are calling for, like, okay, this could be a global depression, something to that scale. Some folks are saying this could be the start to a World War III and such on that scale. Do you think that is like, I mean, obviously those seem like the more extreme in the extreme cases in this situation. And I'm curious, and obviously anything's possible, but is that something that you're factoring into your base case, or what?
Not into my base case, but into my kind of bell curve of scenarios. I mean, there's always the risk of major war, and then of course sometimes that risk is higher than others. Um, if so, if you have just 15% of global energy just go offline for like the next 2 years, that does give at least many regions of the world depression-like characteristics. We were talking before the call about how so I'm going to Egypt in a few weeks because I live there for part of each year, and they already have energy curfews in place. I mean, their natural gas import bill tripled, which means that their electricity, and they use that a lot of that for electricity generation. And so they've literally put energy curfews where a lot of shops and cafes and things like that have to close by 9 p.m. on most nights. And this is a desert country, and so the times are shifted later, so people tend to be out at night in Cairo, especially in Egyptian cities. And so that's actually a lot of business that is like impaired from retail facing shops and things like that. And that's one example. I mean, there are other countries rationing energy. Obviously, jet fuel is now that there's potential shortages in jet fuel. So, and a pretty, non-trivial percentage of global GDP is tourism. Certain countries are obviously more susceptible to others. So certainly, if you have 15% of global energy and certain other raw materials go offline for a year or 2 years, just even half a year, that really does severely negatively impact many parts of the global economy and kind of can stall growth and give us at least severe recession scenarios in the world. They won't hit evenly though. Now, the sooner they open the strait, the sooner there's peace to some degree, and you get at least part of the strait back online. Maybe not 100%, but you get some of it flowing again. That alleviates that acute issue, and you just kind of give us more toward typical stagflation, which is less severe. As far as World War III is concerned, I mean, we live in an age of proxy wars. I mean, nuclear powers never want to engage each other directly, so they engage each other in proxy wars. Like when Russia invaded Ukraine, they thought it would be pretty decisive pretty quickly, and it kind of turned into a boondoggle. They've been there for 4 years now, and one of the things that the United States and others have done is tried to prop up Ukraine to kind of just waste Russian resources, lives, money, arms, all this. It's tragic for everyone on every side. It's who's benefited from all that, and by attacking Iran. And then, there's obviously all this evidence that Iran's getting support from their kind of pseudo allies, Russia, China, and things like that. we've kind of put ourselves into a similar potential boondoggle. Although, we're a little over a month in rather than 4 years in, so we'll see how that goes. But that region has bigger implications for the world because of the Strait of Hormuz and a large portion of energy and raw materials that are stuck because of it. But yeah, I do think we're in an age of kind of proxy World War III, meaning we have this kind of competition for global hegemon status. I think we're entering a more multipolar world. I was just talking on Twitter with someone who was like, by many metrics, 1999 to 2000 was kind of peak U.S. in terms of cultural, global power, and all this. And a lot of that is actually measurable. That was our peak labor participation time because that was our peak demographics. That was the peak penetration of the dollar into global sovereign reserves and kind of the bottom in gold. I mean, people that were focused on precious metals back then, but no, gold was like comically cheap. It was like a few $100s an ounce.
Yeah.
And that was also the UK sold some of its gold at like the generational bottom. And so that was kind of peak power. That was also like geopolitically, that was, a decade after the a little under a decade after the Soviet Union fell. And that was before the major rise of China as an economic power. And so there was this kind of like period of time where the U.S. was like a hyperpower. But that era is over now. So we've had the rise of China. We've had to a less extent, we had the rise of India. We've had kind of Russia reform toward this more aggressive stance that it's currently in. We've had kind of BRICS and other entities try to kind of form some degree of alliances to have alternatives outside of the dollar system with limited success, but there's, it's been working on it. And so I do think we're entering a more multipolar world, which unfortunately so far has included a lot of these proxy fights, which I just don't think a lot of them were necessary. I don't think Russia had to invade Ukraine, and I don't think the U.S. had to attack Iran, but that's the world we find ourselves in.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
With this whole dynamic, there's the talk of the petrodollar system, which was the last, major monetary order change that we've had when Nixon took the dollar off the gold standard, closed the gold window and such, and then this petrodollar was birthed. And currently, the petrodollar is very it pretty much fuels a lot of U.S. Investment assets, and other countries have to transact in dollars. So Iran came out and said that they would be open to opening the strait if the oil was traded in yuan and such, and so that's like kind of coming into the picture now. And then I'm curious in your perspective there. And then also there's this talk of like I haven't done a lot of due diligence here, so forgive me, but if you could explain, like, does the Eurodollar play any role in this? And just curious in your thoughts there.
Yeah, a couple questions unpacked there that I have kind of long answers to them, at least part of it. So the Eurodollar system and the Petrodollar system are kind of one and the same, or at least they're kind of like layered on top of each other. And so people often describe the petrodollar system as kind of like a single decision, as though like someone just said, okay, we're going to make the petrodollar system now. In reality, that was kind of like strengthening an existing system. So prior to the U.S. defaulting on the gold system, even before then, really kind of going back all the way to the kind of the rebuilding of Europe after World War II. Dollars started more increasingly kind of flowing out into the world in this kind of post World War II environment. And Eurodollar, I mean, currently it means basically any dollar outside of the U.S., offshore dollars. But the term originally comes obviously from Europe, which is where a lot of those dollars were, and to some extent still are, but now it's more globally spread. And so you'd have, and then some of those dollars would find themselves into kind of like adversary hands, like the Soviets would have dollars, but they don't want to get sanctioned because the biggest, one of the challenges of fiat currency is if you hold U.S. or any country's securities, let's say the U.S. in this case, if you hold bank deposits that through a chain of custody tie into a U.S. bank, which is what Eurodollars do. They're kind of fractional reserve built on fractional reserve, but ultimately they link back to an American bank and after a chain of liabilities. Or if you own U.S. securities, stocks and bonds and things like that, or private equity. If the U.S. doesn't like you, you can be sanctioned. You can just have your assets frozen with a stroke of a pen. And so you'd have adversaries kind of trying to hide their assets in these offshore accounts in jurisdictions that are trying to be private. And so that's kind of where the Eurodollar came from. And then when you have lending, you'd have cross-border lending. Like let's say in an emerging market and you want to borrow money, no one wants to lend you money in like your local currency that just prints like crazy. And so they say, okay, we'll lend you money, but we're going to lend you in dollars, right? So you owe us something you can't print. That we have more assurances about the dollar. It's the biggest countries in the world currency rather than your local currency. And so you have over decades you had built up kind of these cross-border lending in dollars, and of course. Debt is like inflexible demand for that thing you owe. So when you have cross-border dollar debts, you have cross-border like dollar demand because all those entities that owe dollars need to buy dollars to service their debts, or at least mature their debts over time. And when the U.S. defaulted on the gold standard, we kind of entered a realm of chaos for a while because obviously the dollar was sharply devaluing. There was the first time like the whole world was on a fiat standard, basically except for Switzerland. And the petrodollar was like an attempt to kind of strengthen what was already there, which was the Eurodollar system. There's already this usage of the dollar for all these kind of cross-border purposes, and these are at the time it was secretive, but now there's been reporting that's kind of revealed it over time by quite reputable sources like Bloomberg and so forth that they flew over to Saudi Arabia in the mid 70s and said, okay, only sell your oil in dollars. And retain a lot of your surpluses in treasuries. And what that does is it kind of reinforces the system that's already there. It kind of says, okay, the dollar is the best currency for global oil purchases, for global commodity purchases. And then as you kind of maintain that for years and decades, that takes on a life of its own because it means all those cross-border debts keep happening in dollars. And so even if one day you snap your fingers and oil is no longer only priced in dollars, we still today have something like 18 trillion in cross-border dollar debts. And all of that represents inflexible demand for dollars. So I would say the biggest component of the Eurodollar petrodollar system is that cross-border network effect. Entities they store value in dollars and treasuries and dollar-based assets in large part because the liabilities of banks and corporations and sometimes their own government are in dollars, and international contracts are denominated in dollars. So they have all these kind of like liabilities and some assets backing up those liabilities. And over time, you can chip away at it if you start pricing things outside of dollars, but it doesn't take away that all that cross-border dollar debt exists. So I would say Eurodollar system existed. Petrodollar system kind of came on top of it and strengthened it due to these specific agreements. It kind of kept that flywheel going and accelerated it. And in recent times, obviously, so a big goal of BRICS, a big goal of the Shanghai Cooperation Organization, all these kind of like China-centric things is to try to have payment methods outside of the dollar so that entities can store value that can't just be frozen with a stroke of a pen. When Russia invaded Ukraine, they found a lot of their foreign exchange reserves frozen. And a lot of that wasn't in the U.S. A lot of that was in Europe, and it was frozen, which I don't think they fully expected. Whereas when a country holds gold in its own jurisdiction, it can't be frozen, other than by invasion. If they hold Bitcoin private keys, you can't just, you can try to hack it, but if you can't hack it, you can't just freeze it. If you diversify your reserves among multiple countries, if you have some dollars and some Chinese yuan, each side could freeze their portion, but no side can freeze all of it. So at least you put your eggs in a few different baskets. And so there are all these kind of different approaches. And Iran obviously being more on that BRICS side of things. One of their proposals was, okay, we'll let ships go through as long as they're pricing their oil in yuan. Um, I mean, these we're in a headline-driven environment, so headlines can come and go and change very quickly. Even in the past couple days after the ceasefire, Iran was kind of tolling ships, and they were, reportedly by like the Financial Times and others, uh, saying that okay, pay us in Bitcoin, because if they get paid in dollars or even stable coins, they could just have that sanctioned. Whereas if you make a decentralized Bitcoin payment, the U.S. can't just snap our fingers and freeze that Bitcoin, even if we can kind of trace it in some ways. And so we're in a very kind of a fluctuating environment. But I do think going forward that as we enter this more multipolar world, we're going to enter a more multi-money world, where certain contracts and certain stores of value and certain debts are owed in non-dollar units, because a lot of these countries just want to have more protection from the U.S.
Yeah. So is this kind of like, I think of the saying, um, if it ain't broke, don't fix it. And you mentioned earlier, like, okay, did we really need to attack Iran or join this conflict? Because now it seems like we're put in a position to where the petrodollar system could be dramatically impacted, depending on how this conflict goes. So, would you say that's an accurate assessment?
I think partially. I think the more immediate thing is just, I mean, there's the loss of human lives, both on their side and on the American side, and there's the loss of property. There's the shortage of energy, which is affecting globally as well as here in the U.S. I think that's the immediate issue. The petrodollar system, I think it takes a lot more hits to really undermine it. It's not something that can go away in 3 months or 6 months. I mean, even again, when we froze Russian reserves, that was a milestone along the path. When we see China make certain contracts with Russia or others to price things outside of dollars, those are milestones along the path. This is another major milestone. Um, and Yeah, I think it's secondary probably to the more immediate effects. There's also the issue that I brought up before, that the current system really no longer benefits the U.S. fully. Um, Although it depends on what interest you have in the U.S. So the U.S. government, if you kind of think, okay, there's America, the country, and then there's kind of America, the empire, the government. And if you're America, the government, the empire, you want to be able to surveil everyone in the world. You want to be able to sanction anyone in the world. You want to have your overvalued currencies so you can have 800 foreign military bases and all this. Whereas if you're America, the farmer, or America, the manufacturer, you're not necessarily benefiting from that. And so you generally care less about those abilities, and you just want, to be able to make things affordably in the US. And of course, one of the challenges, and this goes back to the Triffin dilemma, if you run the global reserve currency, it means everyone's using your currency, which means you have to get your currency out to the whole world and keep supplying enough units of it. And the way we do that is through trade deficits. So the U.S. runs these structural trade deficits with the rest of the world. And the mechanism for that is because the whole world needs dollars. So they by extension, there's all this demand for dollars. So they overvalue the dollar on a trade basis. So they make American imports very powerful. We can import a lot of stuff. It makes our exports less competitive, especially for lower margin things like manufacturing. So we're more in the dollar export business, or the dollar securities export business, bonds and stocks and all this, and dollars themselves. And then some high margin things, tech and healthcare, and less so for the middle and lower margin stuff. So the cost of maintaining the global reserve currency is that we erode our industrial base. And the foreign sector, so we spill dollars out into the rest of the world every year. The foreign sector takes those dollars and then they buy American assets. They buy our bonds, they buy our stocks, they buy our private equity, they buy our real estate. So over time, a large and larger share of U.S. financial assets are owned by the foreign sector. And this is a cumulative effect. So when you run that playbook for 45 years, you end up quite imbalanced, where the world owns a ton of U.S. assets, which gives them some degree of control. It's really made our industrial base uncompetitive. And so it actually kind of, in some ways, eventually harms our ability to maintain the status that we have. And you kind of say, well, is the downside of that system still worth the benefit? And so I think for a lot of Americans, it's really not. So I think the bigger question is the Eurodollar, Petrodollar system, or just the dollar as currently structured, is that even serving America's interest anymore? And then two, does this conflict erode it to some degree, potentially? But it also kind of it risks being a sign to the world that our military is kind of reduced compared to what it was, or that, put it more neutrally, technology has changed so that what gave us our power in prior decades is less relevant now. If inexpensive swarms of one-way drones can keep our aircraft carriers away for prolonged periods of time, and if we have trouble opening the Red Sea, if we have trouble opening the Strait of Hormuz against much less well-capitalized adversaries, that kind of impairs our end of the bargain of kind of maintaining safe global shipping lanes and the global reserve currency.
Okay, so it sounds like a lot of the debate right now is whether the emperor has clothes or not. And so, like when I say that, just like what you mentioned just there, like, okay, if we, let's say, this exposes a major weakness to the American military industrial complex, or whatever the case may be. That's a big issue, right? And then we also got the issue of the rare earths and our capabilities there, which are used to go into these military weapons and such. And China still has a chokehold on that. It sounds like there's, I'm looking out, even past midterms. We have, I think Donald Trump has till 2029, something like that. And it's like, okay, well then, let's say we do get a flip, to the other side or whatnot. It seems like there could be some major weaknesses exposed, and I don't even know what that could even look like. Do you have any thoughts on what that could look like?
Well, yeah, you could see a reversal of some policies. I think, just in general, if you're a foreign country, it's hard to do business with the U.S. right now. There's tariffs for a while. There was discussions around invading Greenland. There was, now it's the Strait of Hormuz. It's like, it's just been and you have a lot of countries now trying to directly do business with Iran to say, okay, what do we have to do to get our ships through? And these, some European countries are doing this, some Middle Eastern countries are doing this, some Asian countries are doing this. So we have just a more fragmented world. And I think that'll continue kind of regardless of who wins. Other things change, but I think that one really won't. You can kind of, some of those kind of like alliances could come back, but we still have the problem that we still have a structural trade deficit. We still have a stagnant industrial base. We still have rare earth limitations. And going back, so when UK was the incumbent power, when they were the global reserve currency, they had a similar issue where, they're supplying the world with their currency, they're operating this empire, and you started to get the rise of other powers that were kind of on the other side of that. You had the rise of the German war machine, the German economic machine, for example, the industrial base that they had, and you had the rise of America back then. You had UK was the one running these structural trade deficits, and then America and Germany were the ones running these big surpluses. And now the US kind of finds itself in the situation that UK was in. We're the ones that were financialized. We're known for our capital markets, not our industrial prowess. And if you want to be the best at war, industrial prowess is a big part of that, in addition to technology. And China is now the big industrial powerhouse. They generate way more electricity. They produce more steel than the rest of the world combined. It's like an order of magnitude, like more steel than we do. And a lot of that is tied to how much energy they can produce, because, part of making steel is very high heat. So all those coal plants and things like that. Rare earths are not rare, as many viewers of this program would know, but there's a very kind of costly and environmentally impact just the whole processing environment for them. So in the U.S. and many other developed countries, you have NIMBYism, not in my backyard, whether it's refineries, whether it's just kind of big strip mine areas and things like that. And so that ends up in places like China, which has environmental impacts, but then over the course of decades gives them a lot of leverage. And so as we've kind of pushed out our industrial base, pushed out our mining and refining, and we've kind of focused on finance, it does put us in a little bit of a bind going forward about our kind of ability to make interceptors, our ability to open naval choke points at our whim, our ability to just impact things like that is all kind of reduced now.
Yeah. So in Ray Dalio's work, obviously he talks about we're going through a change in the global monetary order, the geopolitical order, all these different orders that are breaking down and changing. And we can clearly see that we're in the midst of that based on the things that you just shared. And so then we have this dynamic of the fourth turning, right? Which the fourth turning usually argues that there's going to be a big crisis or whatnot. And we've had multiple crises, like plural, and so I'm curious in your thoughts on, like, are you expecting like a one-time big event, to drive this? Okay, now we're clearly, the fourth turning is a cycle. I mean, it's over 25 years. So, is there like a big event that should happen to really like highlight, okay, we're in a conflict, Americans need to come together, blah, 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 whatever, like in past turnings or whatnot? Or do you just see this as like kind of like a gradual deterioration, and then at some point it may come to a head or whatnot? I'm just curious in your thoughts on that.
I think for the most part, it takes the form of a bunch of crises, not just one big one. If you have something like total war or like a nuclear bomb gets dropped or something, I mean, then you can enter kind of all at once territory. But for the most part, these things tend to happen in phases. With the U.S., I mean, we mentioned before how in many metrics, the late 90s and 2000 were kind of like the peak U.S. In terms of disproportionate power to the rest of the world. And you kind of map out what happened since then. I mean, 9/11 happened in 2001. Then all these wars, the war on terror. I mean, I think Brown University estimated we spent something like $8 trillion on the war on terror. Some of it went to good use. Getting Osama bin Laden went to good use, but a lot of that, like especially the whole portion on Iraq that had nothing to do with 9/11. We did the Patriot Act, which is a lot of that is still in place. So we kind of permanently lost some rights as American citizens. Then we had the global financial crisis in 2007, 2008, and into 2009, and so that that kind of impaired a lot of people's kind of trust in the system, especially when you get banks bailed out more so than homeowners, kind of selective bailouts. We had the rise of the Tea Party on the right and Occupy Wall Street on the left. Then we went through a pretty politically polarized time for a while. Then we had COVID, not just in the US, but globally, and major disputes around how to handle that and all the stimulus that got poured out and not evenly. If you do the numbers, there's something like $50,000 per American household in stimulus. And if you ask the average American household, did you get 50,000? It's like, no. It's like, well, someone did, right? You might have gotten 10,000 in stimulus checks and child care tax credits and all this, but there were companies that had no impairment that got $500,000 PPP loans that turned into grants that just drops to the wealthy business owners' bottom line. There are companies running software companies or investment companies that said, "Oh no, we're impaired. We need money." And they just got stimulus checks that were an order of magnitude bigger than the average American. And then we go forward, and Russia invades Ukraine, and then we attack Iran, and we're just in a more kinetic environment now. American kind of military might is challenged in terms of its ability to keep key trade routes open or not. Things like the invention of the hypersonic missile challenges the aircraft carrier as kind of the dominant, other than nukes, as kind of the dominant, conventional force projection. And now one-way drones and things like that further in practice challenge whether that technology is still the number one thing to have. to project force. So I think we've had just a number of crises along the way, and along that way, especially as you have the global financial crisis in the aftermath, and you have the peak in American demographics. So you have a kind of a bloated entitlement system and a healthcare crisis. How many people are overweight? How many people have, just kind of lifelong medical expenses that give us by far the highest healthcare costs in the world per capita. We're just quite burdened. And when you have very high public debt, that kind of puts us into like a fiscally dominant fiscal spiral situation. Not really in the fast sense, but in the slow burn sense. It just kind of year after year, it just kind of keeps accumulating, adding up, where we kind of reach the point for the first time in a long time where we're paying more on interest expense than on military, which is generally, when you have an empire and for decades you have more military expenditures than interest expense, but then it kind of rolls over. That's not really a good sign for an empire. And so I think it's more punctuated by a series of crises than any one crisis.
Yeah, definitely. It's definitely doesn't look too good. So, in your recent newsletter, you mentioned building a watch list and holding cash rather than adding to new positions. Curious in what specific conditions or signals would you need to see before deploying capital?
For the most part, signs that the strait is at least partially reopening, that some ships are able to negotiate to get through on a persistent basis. This recent ceasefire was like an early example, but then it's not clear that that's really going to stick. It didn't really last a full day. It's still in flux. I mean, I don't want to say the conversation could be kind of outdated in a day or two based on headlines. So that's the challenge is, so basically signs that the strait is opening in some meaningful way. And two, just signs of bottoming. I think we're getting to the point kind of close to, there are certain kind of like robust financials maybe worth exploring. I mean, like Visa stock had a big sell-off. Or you look at things like India's largest bank had a really big sell-off. I don't think these things are going to go down forever. So I do think that there's a certain level, whether it's now or whether it's soon, where those things are probably worth looking at for potential multi-year long perspective. So I do think that this crisis will minimize over time one way or another, that at least much of that traffic will resume through the strait. Who's in control of it is an open question. But I do think a lot of that will eventually resume. And when you start to see, not necessarily that it's happening, but that signs that it's likely to happen, on like an investable time horizon, then some of those things that kind of sharply sold off in anticipation of major energy shortages and financial crises, some of those things are worth potentially buying as value plays.
Okay. How are you treating energy right now? I know that you invest in energy and you have some energy producers and midstream companies and such. And so how are you treating those equities? So obviously we had a huge spike in the price of oil, but you had a longer term thesis on energy as well. And so curious in how you're treating the energy plays right now.
Yeah, good question. I mean, so before this, my view was many energy companies have good balance sheets, they're profitable, and they're inexpensive. We had shale kind of not really rolling over, but really not really growing anymore. That kind of imbalance already kind of played out, and so we were in kind of a more energy neutral world. And then it only takes a small fuse to give us a shortage, as we've seen. And historically, a stock and bond portfolio struggles during periods of stagflation. Stocks do well during disinflationary growth, bonds do well during disinflationary recessions. But when you have stagflationary conditions, kind of economic malaise combined with higher inflation, historically neither stocks nor bonds do particularly well. But what does do well is generally hard monies and energy and commodities and their producers. And so I like to have this energy segment because when you have years like 2022 or 2026, that segment can often pay off. And when it's not paying off, at least there's a kind of a floor for how bad it can be because you have these profitable, decent balance sheet companies spinning out dividends and doing good work. So I've been structurally long energy. And during this conflict, I didn't add to those positions because we already had a pretty big run up in those prices prior to the war breaking out. nor did I really sell those positions because it's like it doesn't really change my longer term thesis that I want to be long some of these assets. So I've fortunately positioned ahead of this conflict, and I just kind of remain neutral during it.
Okay. And do you have any thoughts on the fertilizer companies? Obviously the tankers and the exporters that have been going through the strait have been paused, and there's like a lag with. I was talking with Brent Johnson, and he was talking about the lag between when these tankers will get back and get these fertilizers, exported again and such through the strait, and how there's currently there's going to be a shortage at some point. And so, curious in your thoughts on that particular investment thing.
Good question. So I follow that less closely than some specialists do. But because is such a big issue, I've been following. Obviously, natural gas is a big import for fertilizers. Other components that go through the strait are big inputs for fertilizers, including fertilizer itself in some cases. I've been long a couple fertilizer companies, and they've done well through this crisis. Much like energy, I'm not really adding to them, but they're ones I was holding for situations like this. They basically they give me a non-correlated asset that trades on just a different cycle than typical stocks or bonds. And so it's not a big position for me, but I have been long those. But yeah, there's certainly other people that can go into way more detail on fertilizers than I'm able to.
Okay. Yeah, appreciate that. What are your thoughts on gold's performance during this conflict? Typically, people would think that gold would be would perform well when there's global chaos like this. And we did see a sell-off. We do see that even some central banks have been liquidating some gold to get liquid. I mean, folks need dollars, folks need energy and such. And so curious in your thoughts on gold's performance during this time.
Yeah, I think the challenge, of course, is that it ran so much ahead of the crisis. There's already in kind of a local bubble territory. So I've been on the record that I don't think it's fundamentally overvalued, gold and silver. I think it was a repricing from being undervalued to closer to something approximating fair value. But when you move that quickly, sentiment can rise very sharply. A lot of fast money can go into the space, and fast money can go out of the space quickly too when there's a risk off situation when that money's kind of better elsewhere. And so the problem is something is often not a safe haven when it's tripled in price in a short period of time. And I think that's the biggest challenge. I mean, people are saying it's no longer a safe haven. I disagree with that. I just think, again, when things go up that quickly, they can go down pretty sharply. I think even in a prior conversation, you were asking me about $100 silver. It was back before, I think we were at like, say, $60 silver, and you're like, could it go to 100? I'm like, it could, absolutely. But it can also, I wouldn't be shocked if it goes to 100. I wouldn't be shocked if it goes to 40 first, right? I was like, it's like, I had a very firm bullish view on silver when it was like 17 an ounce. But once it's gone up multiples, it's not that I think it's overvalued. It's just that the asymmetry is gone. And with silver, we end up we soared, and then we had some of the biggest sell-offs like ever, and then stabilized. And that's the risk when you've had such a strong upward move. And gold less extreme, but a similar thing. And then people also wondered, well, okay, why didn't Bitcoin sell off? It's usually a risk-on asset. Why didn't it sell off amid the crisis? It's like, well, it already had the opposite problem. It already sold off a ton in late 2025 and early 2026. All that fast money is already out of this ecosystem. The coins are held by pretty strong hands. And so there's not a lot of money that is still there to get out. And so it holds up surprisingly well. I mean, who would have thought, okay, the US attacks Iran, we have the biggest energy shortage in the world, and Bitcoin outperforms gold for a month. Who would have thought? But it's like when you get very overbought in one and very oversold in the other, things can happen. And similarly, like people were like, oh, does this mean Bitcoin's a safe haven asset? My view is no. It just means the fast money was already out. And that's part of why I hold both. They go through their own cycles. And so I'm still structurally long-term bullish on precious metals and Bitcoin. and they kind of move to their own drum, and you just have to be careful of overbought, over sentiment periods of time, in my view.
What are your thoughts on the gold mining companies? I know that you've had them in the past. I know you've had some exposure to some royalty companies as well as some of the miners. And the thing with the miners is like many analysts would say that they're still undervalued because now they're printing a lot more cash at higher gold prices. I had a conversation with Kai Hoffman earlier this week, and he mentioned that the average price of gold per ounce was about 4,100 for Q4 of last year, and I think the average price for Q1 of this year was somewhere upwards of 46 to 4,800. I forgot the exact number, and so curious to your thoughts on the miners moving forward.
So I have a similar view, which is that years ago I was very bullish. I viewed it, there's a ton of asymmetry. As you've seen this kind of sharp rise in gold and silver, we had eventually, with a lag, we had a sharp rise in the miners. I at that point trimmed my GDX position. I'm still long in some portfolios, but it's I've kind of used the opportunity to rebalance and right size those types of positions. Prior to this conflict. So obviously miners, they mine gold, and a big chunk of their expenses is energy. Not all of it, but a big chunk of it. And so prior to the war, when you have a sharply rising gold price but pretty cheap energy, all else being equal, that's pretty good for miners. But then when you risk an energy crisis and when gold eventually stops going up, I mean, that obviously challenges some of the assumptions. If someone has a structurally bullish view on gold, especially more than energy, if they think gold's going to 10,000 while oil stays, 150 or less, then probably miners still have room to run in the years ahead leading up to that view. But if someone thinks gold chops around at 4 to 5K for quite a while and energy chops along, then maybe miners chop along as well. I wouldn't call them expensive. I just think there's quite a bit of risk there. Some of the asymmetry's gone. So I kind of made the decision to kind of leave that space a little bit more to people who focus on it. So I rode what I viewed as the more macro portion of that, which is you buy a generational bottom in miners, you let it run for a long time. Inevitable things tend to take a little longer than you think. So you wait a little longer than I thought. It eventually soared, got multiples. And now I have a less convicted view because we've already had a big run, and I leave that more to specialists that can go stock by stock, find all the undervalued ones, find the ones with good geology, good jurisdictions, good value for the risks and the opportunities that they have, good management. So I think there's still opportunity in the space. I just think you have to be careful.
Yeah, and just your thoughts on me. I've been buying Bitcoin as it's had a lot of weakness. I mean, 50% off the highs and such. So I've been building in my position there. I'm also curious about the next phase. So like we've had like a huge run up. I mean, you had United States president show up to a Bitcoin conference and such. Some folks believe that was like the ultimate bullish signal, and then it reached 125,000 and it's topped out. It's never going to get there again. Like, how much more bullish could you get? But what I'm seeing on the back end is like there's a huge focus around this real world asset tokenization. I'm seeing more tokenized gold products come to the forefront. Even Tether being a investor in some of these royalty and streaming companies and buying physical gold, and they have their gold backed asset as well. And then I'm also seeing that, Morgan Stanley just came out with their Bitcoin ETF and such. And so it seems like there's still some activity in this, in the financial realm around the Bitcoin crypto, real world asset tokenization space. And so curious if you keeping your eye on that and what you're seeing there.
Good set of questions. So I would separate temporary hype from structural adoption. The president attending a Bitcoin conference was good for the price that year, but really it's about structural global adoption. So, I mean, by many metrics, it wasn't even as hyped as 2017 was when that happened, or even 2021, so his appearance in 2024 at the conference. And I mean, since then, I mean, the Trump family has been very much in kind of crypto, even like meme and kind of scam type stuff. And I think I mean, that's kind of on brand. So I viewed it less as bullish for Bitcoin and more kind of it was the signal that it's bullish for deregulation of the space. So the prior administration and Gary Gensler had kind of an adversarial approach. Even for the spot Bitcoin ETFs to allow it to exist, they had to get sued. The SEC had to get sued because they were kind of viewed to be capricious in their like arguments against it. They were also doing kind of like regulation through enforcement. They were kind of not giving clear guidelines for what a crypto security has to do to have a clear path forward. But then when they try things, they would potentially get sued by the SEC. So you went from kind of an adversarial environment to kind of a sort of I mean, like a golden age of fraud environment. It's almost like the pendulum flows around. It kind of opened the doors to the meme coins and kind of grift. I've had a view for a while. I separate Bitcoin and stable coins from kind of the rest of the space. I think that broader crypto is kind of stagnating going forward. I mean, it has ups and downs, but I think it's generally structurally stagnating. And I think the areas of opportunity, I still think Bitcoin is going to be a larger network. I don't think the $2 trillion market cap that it reached was the peak. I think it'll go higher because I think there's a demand for a decentralized ledger backed by energy and kind of a portable store of value and permissionless payments. I think that there's a lot of demand for that. And there's self-reinforcing network effects, kind of like how when you have simple mail transfer protocol or TCP/IP or Ethernet or USB, when you have a software or hardware protocol, these things tend to be very self-reinforcing. It's a winner-take-all or a winner-take-most market. And I think Bitcoin is basically the protocol of value in that sense. Stable coins. So the broader topic of tokenization starts with dollars. So stable coins have been around since 2014. I've been bullish on those. The market cap keeps growing because people want dollars, and it's kind of like a stablecoin compresses the overhead cost of having an offshore bank account. Anyone with a smartphone now has the equivalent of an offshore bank account with stablecoins. Downside, of course, is that because they're centralized, they can be sanctioned at any time. But if you're in a country where that's not a risk and you want dollars for working capital, those are useful. It's a useful technology. Tokenized gold has been around since at least 2018. There's Paxos Gold, there's Tether Gold. Back in I think it was 2020, it was like 2020, 2021. I owned some, so I mean that's useful. It's kind of like how, for a similar reason that some people want gold ETFs. I mean, they're not a replacement for physical gold in your own custody, but for certain pools of capital, they might want that. And the cool thing about tokenized gold is it's not tied to one jurisdiction. You can bring that around with you rather than it being just tied to, say, the American financial ecosystem or something. So I do think that tokenized gold is a valuable thing. I'm a venture investor in the space. I mean, one of our companies tokenizes assets, including securities, equities, to make them more available to the world, right? So it's pretty easy to buy stocks, American stocks, if you're in America. It's not that hard if you're in kind of another developed country. It's a little bit harder if you're in a developing country. And so tokenizing equities or tokenizing attractive securities can make them more accessible and can make them trade 24/7. And so I think that there's some legs to that. I don't think it's like I think there's a limit to how much it'll spread, but I do think that it has more room to go. So I tend to be bullish on Bitcoin and then the tokenization of high quality assets, whether it's stablecoins, gold, or certain equities or securities. And I tend to be more bearish on the meme coin space, the DeFi space, NFT space. That's where I tend to be more structurally bearish.
So for me, I don't outside of Bitcoin and a few real world asset tokens, I invest, but I've also been more focused on a really good friend of mine, Benjamin Damasi. He talks about the analogy of owning the roads and the toll booths rather than owning the vehicles on the roads. And so, I've been investing in, companies like a Coinbase or some of these others that profit, whether it's a bull or bear market, companies that own the New York Stock Exchange, things of that nature, because it seems like they profit whether it's a bull market or a bear market. And so those have kind of been some of the ways that I've been playing that space as well. And so, I appreciate your thoughts on that. So, Lyn, I appreciate you coming on the show and everything and giving us an hour of your time. Where can people follow you and connect with you?
Of course, thanks for having me. People can check out lynalden.com. They can also check out my book on money, Broken Money. And then for those who like sci-fi, I actually wrote a sci-fi book.
Yes,
We all need
yes.
hobbies. So I wrote a sci-fi book called The Stillguard Incident. And it's a near future sci-fi that people can check out. In addition to all this financial talk that we do.
Yeah, for sure. Yeah, I have it on my desk at home, so I gotta crack it open soon. So I'll be sure to do that. Thank you, Lyn, for coming on the show and everything. And you all be sure to go check out the Stillguard Incident as well as Broken Money, and check out lynalden.com. Hit the subscribe button if you haven't yet. Love to have your support. Thank you all for watching.